Welcome to our quarterly market update for the first quarter of 2026. Now, normally when we review the quarter, there are a number of factors that go into why markets have either gone up or gone down. But of course, this quarter, there's really only one thing to talk about, and that's the effects on the markets of the escalation of the conflict in the Middle East. Now, normally when markets are struck by volatility, unless you're a market watcher, you don't really feel it at home. But this time, there's a direct effect on consumers, you and I, and that's through the price of energy or the cost of petrol at the pump. So the conflict in the Middle East has caused oil to spike, and you can see in the chart here that since the start of the conflict at the end of February and the start of March, oil has spiked, nearly 80% just in a couple of weeks' time. Now, that has a direct effect on the cost of living, which means inflation is going to be much higher than expected. And you can see in the chart here, we're showing both Australian and US government 10-year yields. In the last couple of weeks, they've spiked up, and that's on expectations of higher inflation because of those higher energy prices. Now, when you look at Australia, you can see that in the last quarter of 2025, we already had this big increase in yields. And that's because inflation data had come in October saying that inflation was much stickier than what the RBA wanted or was expecting. So the RBA was already going to raise interest rates in February and March of this year, even before that conflict started, and has now increased even further the expectations around inflation. Now, the other thing is bonds are actually performing a little bit of a balancing act here, because normally or typically when there is volatility in equity markets, there's a bit of a flight to quality and people start buying bonds as a safe haven asset and those yields come down. And that's being balanced against higher inflation. And you can certainly see that in the last couple of weeks, inflation is winning that balancing act. So how has all this played out in the Australian market? In the chart here, we're showing both the daily change in the ASX 200, and under that, in the purple line, is actually the daily change in the ASX 200 volatility index. Now, the volatility index is often called the fear gauge because it's a measure of how much markets are moving up and down. When the war started, of course, volatility increased. But in fact, when I look at that chart over the course of the year, the volatility that we've seen from the escalation of the conflict in Iran is nowhere near as high as the volatility that we had when tariffs were first announced in April last year and then put on pause again. And in fact, if I were to show that chart even longer, then the volatility would sort of be a blip that you wouldn't really notice. So while it feels like markets are extremely volatile at the moment, and of course the news is all about markets either up or down today and something different tomorrow, it's probably not as volatile as what you might think. It's only a modest amount of volatility. And so that's kind of reflected in what's happened in the ASX 200 itself. The market is negative for the quarter, but it's down minus 1.6%. That's not that big. And in fact, when I look at the 12 months return, it's up 11.7%. That's really good. That's greater than the long-term annual average. Now, of course, all assets have been affected. Equities are down, bonds are down, private assets, private equity and private credit are both down. Crypto is down. Bitcoin has gone nowhere in the last year. It's back to where it was 12 months ago. And even gold, which is also seen as a safe haven asset, is up over the course of the year, but it's come off 12% from its highs. Let's have a look at global equity markets. And as I mentioned, they're down across the board, but to varying degrees. Obviously, the US is actually the market that's really been hit the hardest. And Because that's such a big part of the world index or the developed market index, you can see that developed markets are down. Europe and Japan not down by as much, and the emerging markets seem quite resilient. They're down a little bit, but once again, the full year return not too bad. So let's summarise. The first quarter of 2026 has been dominated by the escalation of the conflict in the Middle East. Oil prices have spiked up nearly 80% over just a couple of weeks, and that's led to much higher expectations around inflation. Higher inflation mean bond yields have gone up, and that's a balancing act that bonds have had between pricing in higher inflation or a flight to quality because of the volatility in the markets. Equities are down across the board, but actually not by that much. And looking at a longer term, the 12 months numbers are all pretty good. And in fact, when you go further than that, you've got to keep in mind that we've actually been in a fantastic bull market for the last couple of years, ever since COVID. The developed world index we looked at before, it's up like a total of 60% over the last 3 years. Finally, yes, it appears to be volatile times, but the volatility is nowhere near as high as what you might imagine it to be. For long-term investors, stay disciplined, stay invested, and I encourage you just to ignore the news around the uptick in volatility. I'm Steve Garth. Thank you for watching.